What is going on, y'all? My name is Trey. This is Investing by Numbers. Welcome. We talk all things stock market and stocks and investing. I go over my portfolio and the stocks I'm buying every month. So if you're into that kind of thing, hit the like button, subscribe. It helps our channel out more than you know, and I greatly appreciate it. Anyways, today we have had some crazy stock market activity over the last 2 weeks. We hit bear market territory with the S&P 500 just barely for about a day, and then we've come up and we're kind of hanging out above bear market territory. But I've been picking up stocks lately. I put more into stocks last week than I normally do because we hit that big downturn. But I want to talk about the Mag 7 stocks right now because these stocks are the ones that when you go through times where the stock market in general goes down, these are some of the stocks, if they hit new lows, recent lows, they can be the quickest to come back up. So I want to give you my ranking right now on the Mag 7 stocks, and number 1 being my favorite investment, and number 7, of course, being my least favorite of the 7 Mag 7 stocks. So we're going to go over PE ratios, the forward PE, some revenue growth over the last few years, and also net income growth. And guys, this is just my opinion, my ranking. Yours might be different. Feel free to comment below on your ranking. But let's get into these stocks. These are big opportunities, some more than others. So let's get into it. All right, the number 1 stock on the list for me is Nvidia. I talk a lot about Nvidia on this channel. I've been buying up as much Nvidia as possible lately. I'm buying 3 stocks, and during this month and over the next month, I'm focusing on 3. Nvidia is one of those. If you want to know what the other 2 are, hit the subscribe button. I'll be talking about those as well, and watch some of the previous videos, and you'll see what other 2 I'm focusing on as well. But let's check out some things, all right? So the 3-year revenue growth on Nvidia is 383%, all right? And the 3-year net income growth is 647%. This thing is trading at a 38 PE and a forward PE of 25. I mean, for me, this is just a no-brainer. Analysts are still expecting this thing to grow over time, and I think the long-term price outlook on Nvidia has tons of upside. So let's look at a few things here before we move on. This is on macrotrends.net. This is the historical PE ratio graph down here at the very bottom. So right now, of course, we're sitting, around a 38, and this is the lowest it's been since about 2019. Nvidia likes to stay above a 50, as it should, being that it's got this much growth, and it should have this much growth, moving forward, or at least, of course, growth will slow down over time, but we're still expected to see a lot of growth with Nvidia. For me, Nvidia is leaps and bounds above the rest of the Mag 7. For me, it's a no-brainer to be my number 1. Obviously, the net margins are pretty high on Nvidia. I don't know if we're going to see much more growth in the net margin, but we have plenty of revenue growth ahead. So I think that there's still tons of room for growth with Nvidia. I talk about it all the time. I'm not going to bore y'all to death with Nvidia, but that's my number 1. I love Nvidia. I think this one's going to do great things over the next few years. So comment below if you're investing in Nvidia. This is just probably my favorite stock right now out there. Number 2 on the list is Amazon. Amazon has had 36% 3-year revenue growth, 78% 3-year net income growth. We've got a 33 PE on Amazon and a forward PE of 28. So Amazon, y'all know Amazon, okay? But let's check out these historical PE ratios here over the last 8 to 10 years or so on Amazon, and this is why this is my number 2 pick. Now, the next 3 stocks, especially the 2 after Amazon, so number 2 and 3 and 4, all kind of were running neck and neck for me. But the reason Amazon beat the other 2 out is because it's got great net income growth for the last 3 years, and it's had steady revenue growth, double-digit revenue growth for the last 3 years. But the PE ratio is in a great spot historically. So in the past, obviously we had a hiccup here. We had a quarter of no net income, so that kind of made our PE ratio run a little catawampus there. But in the past, we've seen Amazon stay above a 50 PE until, the past, few quarters, past year to 2 years, and it's been slowly kind of dropping down. And we're probably starting to see a little bit of a leveling out, a little bit lowering of a common PE ratio range for Amazon. But still, since this thing has stayed above a 50 and probably goes between, 50 to 100 in the past, and now that we're trading, around a 32 or so, I think a 40 to a 60 for Amazon is probably more of a safer PE ratio range for it. So for that reason, I think we're getting a great deal on Amazon right now, and that's why it's my number 2. Historically, we're just seeing a great trailing PE and forward PE for Amazon, and Amazon runs is just, they're such a well-oiled machine, and I don't see anything slowing down for them over the next few years. Amazon's always a buy. When you see a dip, they're just one of those companies that is just it continues to run well. Bezos is doing great things with Amazon. Love them or hate them. I know a lot of the billionaires these days catch a lot of hate, but either way, fantastic company when it comes to growth and those net margins. So number 2, it's Amazon for me, and it's a pretty easy buy. I'm not buying Amazon right now, but I think anyone buying Amazon will do really well over the next few years, and I think it's a fantastic second pick for me of the Mag 7 stocks. Number 3 on the list is Meta. Meta has 39% 3-year revenue growth and 58% 3-year net income growth. We're sitting at a 22 PE and a 21 forward PE. Meta trades cheap PE wise, which is, you would see these PE ratios and think, well, isn't Meta trading a little cheaper than Amazon? But Amazon just tends to trade a little more rich than Meta. For whatever reason, people are willing to spend more money on Amazon over Meta stock. And so I kind of like to look at that historically more so than just comparing it to others' stocks. Not every stock is created equally. Some companies people just feel carry a little less risk. But Meta's a great company, and they're expanding pretty well. The metaverse and all the stuff they carry with their other social media platforms and stuff. But the main reason that Amazon beat it out for me was that we saw this big dip in 2022 where Meta dropped all the way down to around a 13 PE. But in general, it's pretty common for Meta to get, right around a 20 PE. We're close to it. And right now we're sitting right around a 22 or 23. So I think that, Meta's definitely in a very fair value range at the moment, and it doesn't have a lot of range as far as their PE ratio goes. Now, that doesn't mean that, they could enter a new era and shoot up and start trading between a 40 and 50, but this thing tends to stay pretty regular when it comes to its PE ratio range, and for that reason, the fact that it's kind of trading more so in that fair value as far as its historical PE ratio range, it's number 3 on the list for me. I think it's a great buy. I think it's a great company. And I think if you're buying Meta, you're going to do really well over the coming years. I mean, they're another just fantastic company, just like Amazon, just like Nvidia. It was hard for me to pick really between Amazon and Meta, which one I felt like was my top pick between the two. But I went with Amazon just because it trades a little more rich, and I think there's a little more room for profits in the next few years than Meta, but we'll see. I could be completely wrong on that. Either way, both great companies, and like I said, I think if you're buying Meta right now, I think you'll be doing really well over the coming years. The next stock on the list, number 4, is Google. Google has 36% 3-year revenue growth, 32% 3-year net income growth, a 20 trailing PE, and an 18 forward PE. This was tough. Really, for me, going between Meta and Google, this was a tough one. Even really Amazon. I mean, it runs close to Amazon as well. Like I said, these number 2, 3, and 4, these were hard ones for me to pick between. Obviously, Google has a little more less room as far as the net income growth year over year than the other two. So that was one reason, the main reason it came in at number 4 versus maybe number 3. But we've got steady revenue growth, just like the other ones. Just a little less net income growth moves here. But the fact that it trades at a 20 PE and an 18 forward PE is great. You know, very low PEs there. But also going back like Meta, Google, as you can see down here, this is kind of the range it stays in. It stays between, you know, a 20 and a 30. Kind of like Meta. It likes to hang out in this range. So it's a little more range bound as far as a PE ratio goes. We are near the bottom of that range right now. We're sitting somewhere right around what I say a 20, and I'd say that's getting into great value territory for Google. Obviously, still another great stock. It's number 4 for me, but still, it's right there neck and neck with the previous two. You know, Meta and Amazon. I think all three of these are great buys, and it was hard for me to pick between these three. For me, Nvidia was definitely an easy pick, but these next three were tough. But for me, Google's comes in right there at number 4, and another company that's doing great things. Also, another reason I think Meta's just got a little more room to grow with their products. Google, you know, they have, of course, their phone and everything, but for me, I feel like Meta's got a little more growth as far as products goes over Google. And so another reason that Meta came in a little ahead of Google for me. But still, Google's a great company. And like the previous three, if you're buying Google, I think you'll do very well over the coming years with that investment. Number 5 is Microsoft. Microsoft has 46% 3-year revenue growth, 44% 3-year net income growth. We're sitting at a 31 PE and a 26 forward PE. Another great company. This one was kind of tough too. I think because the PE ratios are going to be higher than these previous two, like Meta and Google. These things just trade kind of cheap as far as the PE ratios go. And Microsoft sitting a little higher up here in the 30s. That's really the reason it came in at number 5 for me. Also for Microsoft, looking here at the PE ratio range, you know, a 31 is sitting, you know, kind of, I would call it fair. It's sitting a little elevated from the past. I mean, obviously this thing can get down into the low 20s as it did back in 2016. But even in 2022, you know, we came down below 25. And 25 is a pretty common theme back here. So I would say fair, but I would say under 25 is a really great range for Microsoft. Still, I think we're sitting at a good deal for Microsoft. Also, with it being around as long as it has, I think that there's a little less room as far as growth goes. Even though we've had more growth over the past 3 years than the previous 3, I think that the fact that it's been around longer, you know, than Amazon and Meta and Google even, I think that there's just there's a little more of a compression there as far as of growth rates. But I could be way wrong on that. Obviously, the numbers of the past 3 years, as far as revenue growth have been better. You know, Amazon and Meta, obviously the net income growth for those has been considerably higher than Microsoft, but not Google. So I don't know, we'll see. But the fact that obviously it's hanging out at that 31 PE, I'd really like to see this thing closer to a 25. If this was sitting at a 25, I think this would be, you know, it'll probably close on my number 3 spot, maybe number 2, but probably somewhere around number 3. So still, this one was coming in pretty close with these previous 3 as well. This was probably the last one that I thought was a little tough to grade. These top 5 I think are great buys. Maybe the top 4 a little better than Microsoft, but I still think Microsoft is a good deal. It's fair valued right now as far as the historical PE ratio goes. But with this kind of growth, you know, 46% over the last 3 years, and you know, I think that you know, hanging out at a 31 PE is completely reasonable of a value for Microsoft. Number 6 is Apple. Apple, you know, has been around a long time. Huge moat. I mean, the iPhone and everything, Apple is just has a huge moat. But they've been, you know, their numbers have been a little lacking over the last couple of years. Obviously, over the last 3 years, 7% revenue growth. So, you know, small digit revenue growth there. And net income over the last 3 years is down 1%. So pretty much breaking even net income wise. So we're not seeing any growth there, which is understandable as far as, you know, a company that's been around as long as Apple. The fact that net income is kind of running flat, isn't too crazy. I mean, with revenue growth being 7%, I'd like to see this at least in the positive, but also, 7% over the last 3 years, not so great, but Apple's also very historic and has a strong moat. Now we're trading at a 32 PE and a 27 forward PE. So this is another issue for me why it came in lower on the list. If you look down here at the PE ratio range, obviously back here before 2020, this thing stayed below a 20, all right? That's where it traded. And then after 2020, it kind of got elevated. And just in the past year or so, it's even more elevated. I mean, obviously we got up to a 40, but right now sitting still in the 30s, I'd really want to see this thing in the lower 20s to consider it, a good value. I even think we're just, as far as historically how it trades, we're a little elevated PE ratio wise, and that is because it struggled with numbers a little bit. And so for me, it's just not a buy right now as far as how things have been going lately for Apple. There's just too many other great deals out there for me to consider Apple a great deal. Doesn't mean you'll do very well if you're investing in Apple. It's a strong company, and I'm sure it'll continue to be. I don't see Apple going anywhere. But just looking at the numbers, they'll probably turn it around a lot of times when this happens, when a company like Apple that's been around, since the early 80s goes through kind of a rough segment, where their numbers are kind of stagnant. A lot of times we'll see some growth ahead of it. So, but with the PE ratio being a little elevated for it, it's just a little lower on the list for me, and that's just my opinion of it. Why it comes in number 6 for me. Number 7, Tesla. Tesla has an 82% 3-year revenue growth, 29% 3-year net income growth. We're sitting at 124 trailing PE and a 90 forward PE. It was kind of tough for me to pick between number 6 and number 7 as far as Apple and Tesla goes, but really it just came down to the fact that there's a lot, in my opinion, there's a lot of risk for Tesla right now. Obviously, the price is pretty low from what it's been in the recent year or so, but we're still sitting at 124 PE and a 90 forward PE. So these numbers are pretty elevated for the past couple years. And Tesla in the past year has been struggling with numbers. And the reason it comes in number 7 for me over Apple is because Apple's got a little more stability to it, being that it's been around for so long. And Tesla's just going through a lot of ups and downs right now. Obviously, they were a darling going into 2020. Their stock was just going through the roof, and they've seen a lot of ups and downs. And of course, we all know Elon Musk is very polarizing as a CEO. He's got a lot of stuff going on. He's involved in Doge and with the president right now. And so there's a lot of people loving him, but there's also a lot of people hating him. And, with the EV market, a lot of the liberal side, the left, is very pro EV market. So a lot of them going into things were very supportive of Elon, and now it's kind of like he's flipped sides politically. And so a lot of his core consumer base is now kind of turning against him. But we'll see, I mean, he's obviously got SpaceX as well, and he's just a very busy guy. And for me, I really want to see my CEOs focusing on the company they're running. And I think that's also been talked about lately, that he's kind of, he's a little bit distracted with a lot of things, and he probably needs to get back to Tesla and really focus on it. So that's my main reason for why Tesla comes in last, even though they've had good revenue growth. Obviously 82% revenue growth, but only 29% net income growth, which of course, it's still an automaker, so things can get pretty volatile with them. Let's check out the PE ratio range for Tesla. It's a little bit more all over the place. Obviously, they've kind of, they've only been into profitability in the last, 4 to 5 years. So they're still kind of finding their groove as far as, being in positive net income range goes. Come on, where are we at? Price ratios, give it to me. So yeah, coming down here, we'll zoom into the last, just a couple years to get kind of a better base. 2022, they fell pretty hard and got down to a 34 PE, which I thought, at the time that was a pretty good range. I've never been a buyer of Tesla, but if I was going to be a buyer, I was almost looking at it back then. And as we got into this period here, numbers started growth started slowing down a little bit, but obviously we got down all the way to a 34 back in 2022. And even back in 2024, when we came down again, we came in under a 50 PE down to around a 45. And, I prefer to buy stocks under a 50 PE. That just lowers my downside. And with Tesla's revenue growth slowing and their income slowing, even though the price is considerably down from all-time highs, I just don't want to be buying a stock that's this far down but still trading at 124 trailing PE and a 90 forward PE. Now, if it had a forward PE of under a 50 as well, then I'd be a little more interested. But right now, the numbers, they're just a little risky for me. And so that's why, for me, Tesla came in at number 7. Doesn't mean if you're buying it right now, you won't. It can't just in the next year come back to all-time highs. Tesla's a crazy stock, and that's another reason for me it's number 7. Is I kind of prefer to invest in things that are a little more stable. And as far as Tesla goes, even it being a little all over the place, I really want to see those PE ratios a lot lower. 82% revenue growth and even the 29% net income growth, that's okay. I'm fine with that, but I need to see those PEs coming down a little lower for me. But that's me. I'm a little less risky when it comes to investing in these stocks. I like to stay under a 50 PE. So that's my list 1 through 7, y'all. Like I said, Nvidia for me was a really easy, no-brainer number 1. Number 6 and number 7 were kind of for me easy to I knew those would be in the bottom 2, but little tough between those two. Obviously, Tesla has more growth going on than Apple, but it's more risky and a little more expensive. But those middle, 2 through 5, those were, I was really having to, I changed my list a couple times with those, and trying to pick which stocks were going to be which. I really had to start looking at some different numbers. Now, one thing I didn't go into with this list, I really didn't get into balance sheets, cash flows as much. I wanted to keep things a little bit easy since we are kind of in a correction market, almost in a bear market, kind of going back and forth there. I kind of wanted to keep things easy as far as just really looking at revenue growth, net income growth, and those PE ratios and their historical ranges. But that's it for me, guys. Kind of a fun video. It's always fun to do rankings as far as stocks go. Like I said before, if you have a good ranking yourself, comment below, give me your ranking, and I will catch y'all on the next one. Thanks for tuning in.